Wait, does this work? Can you hear me now? Can you? Oh no, you can't hear me anymore. Oh, I think my audio is broken. Oh, can anybody hear me? Okay. Ooh, you can hear me. Excellent, excellent, excellent. Perfect. All right. Well, then never mind. All right, we're gonna go back to the three T's then. Um, So today we're going to talk about the three T's of real estate investing. We got an email from one of our VIP list subscribers, and this person says, quote, a big deterrent for me is getting more heavily in I'm sorry, a big deterrent for me in getting more heavily involved with real estate investing is having to deal with the three T's. So this is a very common sentiment. A lot of people um, want to invest in real estate. You want to earn income from a piece of property that you own, but it's you know there are so many unknown unknowns. There are so many uh, risks that that the three T's, tenants, toilets, and trash, are going to take up a lot of your time. And all of a sudden, you're going to be chasing down rent payments. Let's talk a little bit about like the kind of the fears or the what ifs, right? You might be chasing down rent payments and getting 2 a.m. phone calls saying that the toilet is clogged. You might be dealing with broken cinder blocks strewn all over the front yard, or tenants who move out and leave bags and bags of rotting garbage everywhere, right? These are all of these worst case scenarios that people imagine. And of course nobody wants to deal with that, particularly when this is something that you're doing on the side, when you have a full-time job, probably a fairly demanding full-time job that takes up a lot of your time, and then maybe you have a family. You've got a lot of things going on and you don't want to necessarily be dealing with tenants, toilets, and trash. So, what is it that you can do in order to reduce the burden of the three T's? Well, there are a few things to to discuss here. One is that properties, broadly speaking, are classified as Class A, Class B, Class C, and Class D. Now, there isn't any type of formal classification structure. There isn't an independent council that sits around classifying every property based into one of those four uh, letters. But it's commonly understood amongst real estate investors that this is a Class A property versus this is the Class C property. And if you think about risk and reward as existing on a spectrum, right? If something has higher risk, then it often has higher potential reward, meaning you might be able to make more money on it, but it might also produce the greatest amount of headache. Um, Conversely, if something has lower risk, then you may not make as much money on it, but it's also likely to have far fewer headaches. So if you think about the world of index fund investing, we see in index fund investing that trade-off between risk and reward, right? The more generally, historically speaking, the more stable a given asset class is, the lower potential rewards that it has, but also the less volatility it has, and therefore the less worry you're going to have about it. Conversely, there are certain asset classes, like let's say frontier markets, that historically speaking have a high degree of volatility, therefore a high degree of risk, but they also could theoretically have the highest potential reward. The same exists in real estate investing. And so when you are selecting a property, you will want to think about, do you want to target properties that are Class A, B, C, or D? Class A being properties that tend to be newest construction or recently renovated. They have typically much higher rents, lower turnovers, lower vacancy rates. Uh, they typically tend to attract more stable tenants who stay there for longer and who often are more qualified. The tenants often have income that is a higher multiple of the rent and tend to have higher credit scores. By contrast, there are properties that are Class C properties where Tenants will have income that is not quite as high of a multiple of the rent, and there might be higher turnovers. These properties are typically older, they're in worse condition, which means that they often have higher repair and maintenance demands. And oftentimes there can be higher vacancy risk. But there's a potential for more added value, more potential upward potential with a Class C property. And so it completely depends on what your strategy is. There are some people who love Class C properties because they love the potential to earn higher returns in those properties, and they have the eagerness to embrace some additional challenges in pursuit of those higher rewards. And by contrast, there are others who say, no, you know what? I want the most stable types of properties that I can find. Give me class A all day, all the way. Right. And there's no right or wrong answer to it, just as there's no right or wrong asset class in index fund investing. It's purely a function of what you want to do. Now, let's dig into the three T's one by one, because what's interesting to me is tenants, toilets, and trash. When you take them at face value, they all seem to be the same subset, the same category, and that is the category of property management. Right? With property management, you market to tenants, you screen tenant applications, approve a given tenant, go through the move-in process, the onboarding process, right? And then collecting that rent from tenants every month, responding to their maintenance and repair requests. That's the ongoing work of managing tenants, and then the toilets and the trash really are subsets or subcomponents of that. So what's interesting about the three T's model is that it sort of teases out, if you will, pun intended. It teases out what is really all under the same umbrella, under the same large subset of this is property management. And so the um, tactic that a lot of real estate investors take is, look, if you really don't want to deal with property management, um, that's fine. There are a lot of professional property managers who will take that off of your hands. And one of the most common responses that we get to that is, yeah, but don't you have to pay them? Well, that's true in any business. I mean, in literally whether you're selling shoes or selling protein powder, in any given business, if you want to grow and expand a business, you hire people. And that doesn't diminish from the profits that the business makes. It frees up your time to be able to do more profitable activities. And so, whether you spend your time doing more profitable activities in the form of growing your real estate portfolio, or whether you spend your time doing more profitable activities in the form of leaning into your day job further, or whether more profitable activities means growing out some other side hustle, like however you define, or maybe for you, profitability is time with family or time at the gym, right? Maybe it's a non-monetary profitability of life. However you find higher value time, you are able to acquire that higher value time by virtue of delegating out this piece of it. So if you really don't want to deal with the tenants, the toilets, and the trash, again, you hire that out. So there are a few things to bear in mind as you think through how to actually logistically plan for that cost. Now, number one, and I encourage all of my students in my course, Your First Rental Property, to do this when they're analyzing a property. Always, 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 when you analyze a property, analyze it as though you are hiring property management from day one. And do this even if you plan to manage the property yourself. Now, the reason for that is because for math to truly be math, it must be identity agnostic. And what does that mean? It means when you're running a spreadsheet, trying to determine the profitability of a given property acquisition or rental property acquisition, it is BS mathematics to say, hey, um, if I do this job, then the payment to the property manager is 0. But if somebody else does this job, then the payment to the property manager is greater than 0, right? To value your own time at 0, but to value somebody else's time at greater than 0 is it's just BS accounting, because it means that the spreadsheet is no longer identity agnostic, and that's just not how calculations work, right? To determine if a property is going to be profitable, to determine what kind of cap rate it's going to have, to determine what type of cash on cash return it's going to get, you need to know what the numbers are, and you need to know these in an identity agnostic manner, because you want, if one day you get a job offer in Jakarta and you end up moving to Indonesia, you want to be able to make that move and replace yourself and have all of the numbers stay the same. So even in the case, we have some students who say, "Well, but why should I put in my spreadsheet modeling, why should I model for paying a property manager if I'm planning on doing it myself?" Again, it's because you want that math to be identity agnostic. You want the option to move to Indonesia at any point at the drop of a hat and have the numbers stay the same. And so even if you do manage the property yourself, you embrace a little bit of split personality. You've got investor you, and then you've got property manager you. And by the way, this works not just for property management, but for any given line item within a property analysis that you would be conducting. So if you're house hacking, for example, and you're going to live in one of the units, again, you run the numbers as though you are renting from yourself. So there is owner investor you, and then there is renter you, and renter you pays rent to owner you. So you pay rent to yourself, right? And that's a way of keeping the math identity agnostic. Same thing if you are very, some of our students are very handy, and a few of you, you put yourself through college by painting houses or by roofing or by doing general handy person work. And so, you want to do, in fact, you're actually excited about doing some of the work yourself when it comes to repairs or maintenance or CapEx. That's great. We have some students who are like that. Wonderful. But when you're running the numbers, you run those numbers in an identity agnostic manner so that you can always replace yourself at any time. And so that's another piece of, dealing with the three T's of rental property analysis, where a lot of real rental property investors get themselves stuck, is that they will make the mistake of running an analysis on a property as though they're going to do the work themselves, and then they're stuck to having no choice but to do the work themselves because they selected a property in which the numbers wouldn't make sense in any other way. And so that's simply a matter of poor selection of property. That's the reason why in our course, Your First Rental Property, we put a huge emphasis on the very first module, which is how to analyze a property. And we lead with that. We put that right up front because you win or lose the game at the end of the day based on the property that you select. Like everything that happens downstream from there is nice, but the single most important decision is the property that you select, because not all properties are good rental properties. In fact, I would go so far as to say the vast majority of properties are not good rental properties. The vast majority of properties are poor rental selections. And by poor rental selection, what I mean is that it doesn't generate an attractive enough cap rate to justify the acquisition. And what is cap rate? Cap rate is essentially an expression of the unleveraged dividend or the unleveraged income stream that would come from that property. And we cover all of that in the course. But the reason that we lead with that, the reason that we have a very, very robust spreadsheet and very, very robust modeling on how to conduct proper property analysis is because tenants, toilets, and trash are not going to be an issue for you if you choose a property uh, that can handle it. If you choose the right property where you can outsource the property management, if you choose to do so, and you still get really fantastic returns. Now, in terms of taxes, because taxes, what's interesting to me is so tenants, toilets, and trash, those all fit under the subset of property management. And then you've got this additional T, the fourth T, right? Taxes. And what's interesting to me about that is that taxes are a completely different subject matter. And yet it's a subject matter that scares off a lot of would-be investors. Um, but the good news is that your tax burden on rental properties is not going to be as bad as you might think it is. I mean, I don't know what you think, but rental property investing, according to the IRS, is considered uh, passive activity. So your gains as a rental property investor, that is considered passive income. Now, there's a huge controversy in the financial world. Um, in personal finance, people say, well, there's no such thing as passive income. Yet, but from an IRS designation, the IRS designates this as passive income. So you can there are a lot of people on Twitter who wanna have an argument about what is passive income. The IRS says that that rental property income is passive income. So, from a tax perspective, it's considered passive income. And what that means is that passive losses offset passive gains. So, any passive gains, meaning returns that you make on that property, can be offset by passive losses. And where passive losses become really important is the fact that you can depreciate all of the components of that property. So, you have, when you buy a property, your roof depreciates a little bit every year, right? If the lifespan of that roof is 25 years, 27 years, 30 years out, whatever the formal IRS designation is, right? That roof is depreciating by, let's say it's 27 years, by 1/27th of its natural lifespan every single year. Those windows are depreciating by, we'll say 1/27th. I don't know exactly what the year designation is. There's a table on the IRS website that has that information. But those windows, the roof, the flooring, the siding, the gutters, every single component of your home is depreciating a little bit each and every year, and that depreciation offsets the income that you collect. Now, this does work both ways. The years when rental property investors find themselves with big tax bills are the years in which they outlay for major renovations, major capital expenditures that they can't write off in the year in which they make that expense. So if you make a repair, right, if the sink is leaking and you need to just send a repair person in to fix it, that whole thing is a write off. But if you do a huge kitchen remodel, right? You can't write off the entire cost of the kitchen remodel in the year in which you make it. You have to depreciate it. So, in a year that you are planning to do a major renovation, part of the budgeting for that is budgeting not just for the renovation, but also for the tax burden that you would have to pay in the year that you outlay that cash. But so that year, that one particular year, the year that you make a major capital expenditure, that is a heavy tax year, but that is typically something that you will plan for. You're not gonna accidentally do a kitchen remodel. You'll make repairs, as needed until you have planned and prepared to do that kitchen remodel that you've been planning to do for the last 4 or 5 years, right? So, there's time to plan for that. Um, and that other than that 1 year, every other year, your depreciation is offsetting a lot of the gains that you make. And so real estate can actually be, a fantastic kind of, and when it comes to, especially for people who are in a higher income tax bracket, real estate is a way to collect income and build equity and build your net worth without necessarily taking a big tax hit, because there's so much that you can depreciate and write off against the income that you're making. So, so that is a little uh, thing about the 4 T's, or the 3 T's, but really the 4 T's. And that is a response again to an email that we got from a member of our VIP list. So, if you would like to join the VIP list, it is absolutely free. You can join it by going to affordanything.com/VIP list. It's affordanything.com. Oh, I should write it here. Affordanything.com/VIP list. Um, There we go. And you can join our VIP list. We have a course on rental property investing. It's called Your First Rental Property. We only offer it typically twice a year, once in the spring, once in the fall. We are offering it in the spring. We're offering it starting May 22nd. So, May 22nd through May 31st is when we are offering this course. That's your window to enroll. After that, we close our doors. If you want some information about the course. I'm going to put this on the screen as well. There we go, affordanything.com/enroll. If you go to that page, you'll see a lot of information about the course. We've got, as I mentioned, a module on how to analyze properties, one on how to find properties, how to finance properties, how to renovate properties. We talk about how to think through a renovation, what's feasible, what's optimal. Um, we talk about how to manage tenants. So we cover the total A through Z, and we give you checklists and spreadsheets and worksheets. There are study halls. We have active investor mastermind calls. We have accountability groups. We have teachers' assistants who are there to answer your questions. They're all alumni from the course. So it's a very white glove, high touch, full support experience. So again, join affordanything.com/VIP list. We'll send you a lot more information, and check out our page, affordanything.com/enroll. And remember, enrollment opens May 22nd, and we close our doors May 31st. So that is your window to enroll for the spring 2024 semester. Thank you so much for watching. My name is Paula Pant. I will be back soon, shortly, to answer more questions that come from subscribers to our VIP list. All right. Thank you so much.